Hi guys, welcome to 365 Days, 365 Concepts. The concept that we're going to understand today is residual claim of equity shareholders. But before that, we'll understand different sources of capital. The first source of capital is debt, basically borrowing. Right? Let's say, for example, I have taken a 10% loan of rupees 1 lakh. That means I'll have to pay an interest cost of rupees 10,000. And let's say this loan is taken for 5 years. That means irrespective of my profit every year for the next 5 years, I will have to incur an interest cost of rupees 10,000. That means this is a contractual obligation. Sir, what do you mean by contractual obligation? Whatever my revenue be, I will have to pay this interest cost. The debt holder is not going to come and listen to me that, okay, this year your revenue is less, so you pay me lesser interest. No, that's not how it's going to work. You will have to pay rupees 10,000 every year for the next 5 years, and interest payments are contractual obligation. Sir, there are no voting rights for debt holders. Debt holders do not get to, vote in the matters of company, like appointing a director, like, whether dividend should be paid or not, and stuff like that. Now, the next category of source of capital is common stock, or also known as ordinary shares. Now, what are ordinary shares? Sir, ordinary shares, whenever I take a share in a company, ultimately I'm going to get what? An ownership interest in the company. And the second point, which is residual claim, we will talk about this at the end. Now, like I have an obligation to pay interest every year, that irrespective of my profit, I will pay rupees 10,000 to the debt holder. Do I have an obligation to pay dividend to the ordinary shareholder? No, sir, there is no such obligation. If I have profits, if I feel I should distribute dividend to the normal shareholder, ordinary shareholder, then I will, otherwise I won't. And that is the third point, that there are no obligation to pay dividend, but common stock or ordinary shareholders do get voting rights in the matter of company. Sir, what do you mean by that? Let me quickly take you guys to the stock of Tata Motors. As you can see right here, in case of Tata Motors, see, on different matters, shareholders have voted. Which one? Ordinary shareholders. Sir, what are the matters? Example, to declare dividend on ordinary shares, to appoint Mr. Girish Wagh as director, and matters like this, to reappoint Mrs. Vedika Bhandarkar as director, and stuff like that. So as an ordinary shareholder, I do get voting right in the matters of the company. Sir, the next part is preference shares or preferred stock. Sir, what do you mean by this? Sir, preferred stock has features of both debt and also equity. Sir, why do you say that it has features of debt and equity, and what do you mean by preference shares? Let's say, for example, company has issued 10% preference shares with a face value of rupees 100. Sir, what do you mean by 10%? 10% is the dividend that has to be paid on this preference share. That means rupees 10 is the preference dividend that has to be paid for the providers of preference share capital. Okay, sir, we get this. But is it a contractual obligation, like you have to pay 10% interest every year? Is it a contractual obligation? No. If a company has sufficient profits after paying interest, after paying taxes, it will pay the preference dividend. Right. So, sir, it has features of both debt. Sir, why does it have features of debt? Because whatever dividend the preference shareholders are going to get is going to be fixed. Are they going to get dividend or not? That depends on profit. But if they get dividend, they will get fixed dividends. Sir, there are no voting rights on preference shares. Like how your equity shareholders, which one? Ordinary equity shareholders get voting rights in the matters of company. Preference shareholders do not get any voting right. Okay, sir, we get this as well. Sir, what are the features which are equity like? Sir, dividend, which is to be paid on preference shareholders, is not a contractual obligation. If the company has profits, it will pay it. And sir, shares do not have an expiry. Sir, what do you mean by this? Sir, here in debt, the debt is going to retire or is going to, what do you call, it's going to mature in 5 years. But in case of equity shares, sir, equity shares are going to exist till the company exists. Preference shares are going to exist till the company exists. And sir, initially you left off a point which is called as residual claim. Why do you say that equity shareholders, which are normal equity shareholders, have what? Residual claim. Let's say, for example, in an event of liquidation of a company, that means company is wrapping up its business, it is shutting down. Let's say, for example, I can recover these amounts from selling the assets of the company. Sir, what amount? Sir, in scenario number one, I can recover 50,000. In scenario number two, sir, 1,50,000. In scenario number three, 2,50,000. In scenario number four, 5 lakh. That means these are the amounts that I can recover if I sell my assets tomorrow in an event of liquidation. Let's discuss each scenario, but let us first understand what is the amount that is owed to each source of capital. Sir, what is that amount owed to each source of capital? Sir, for debt holder, it's rupees 1 lakh. For preference shareholders, it's rupees 1 lakh. And for equity shareholders, it's rupees 2 lakhs. That means if the company tomorrow is able to only recover 50,000 from selling its asset, the entire amount will go to debt holders and preference shareholders will get zero and equity shareholders will get zero. This is called as hierarchy of claims. What? Hierarchy of claims. What do you mean by hierarchy of claims? In an event of liquidation, debt holder will get their money first. Then second the money will be gotten by debt holders and second the money will be gotten by preference shareholders, and third the money will be gotten by your equity shareholders. So the first priority has to be the debt holder, second preference shareholders, and third equity shareholders. Sir, tomorrow if we get 1,50,000 from selling the assets, sir, entire money first has to flow to debt holders. Now, it was owed 1 lakh rupees, it got entire 1 lakh rupees. That means remaining amount, that is 50,000, will entirely go to preference shareholders because they come second in the hierarchy. Sir, if the company gets 2,50,000 from selling its asset, then how the distribution would work? Sir, equity debt holder will get the entire amount. Sir, preference shareholders will get entire amount. That is 1 lakh each. Whatever will be left over, that is 50,000, will be gotten by equity shareholders. Notice, equity shareholders are owed entire 2 lakh. But in scenario number one, they only get zero. In two, they only get zero. And in three, they only get 50,000, which is the leftover amount, residual amount. Right. And in the fourth scenario, where the company is getting rupees 5 lakhs, debt holder will get 1 lakh, equity preference shareholders will get 1 lakh, and equity shareholders will get the entire leftover, which is 3 lakh, even though they were owed only 2 lakh rupees. That means it can go either ways for them. They can either get zero or they can get more than what they are owed. And that is what you mean by residual claim. That means a claim where the equity shareholders will realize whatever they are owed at the end, basically left over. And that's why the risk that is taken by equity shareholders is much more. And that's why they demand a higher return or a required rate of return. That's it for today. I hope you guys understood everything. Thank you so much. Please like, share, subscribe, and comment. And if there are any doubts, feel free to ask in the comment sections. Thank you so much. Bye bye.